Hey, good afternoon, everybody. I wanted to talk to you a little bit about seller financed mortgage notes. This is our topic coming in January at Mary, and I kind of wanted to tell you why and give you a case study so you can kind of see how it works and how it might work for you. We have three ways to profit with seller finance notes, at least three or four ways that we did on a Blue Springs house. This was back in 2013. We've done seller finance deals before that, after that, but this one actually just has so many moving parts, it gives you a lot of ideas. So, why are we talking about seller finance deals right now? We got to get the slide to advance. There we go. There we go. So why seller financing? Why now? Well, one of the biggest reasons and why we did this case study, our reason, we had a flip and nobody was buying it. We had reduced our price and reduced our price and reduced our price. And we were looking for some other way to make money. We knew that if we offered seller financing, that increases our buyer pool and we could sell it for a little bit more than we would cash or to somebody with a bank loan. But we didn't quite know how to do it correctly, but we learned on this deal. Another reason why we're seeing people turn to seller financing is the hot strategy of BRRRR, buy, renovate, rent, refinance, and resell. Well, with expenses way up on, buying the house, interest, rehab, taxes, insurance, all of those costs are up 60% or more across the board. And while rents are up, they're only up about 20%. So they're just not as profitable if you're going to BRRRR. And then everybody was all about subject to, subject to, subject to. Well, now banks are calling those due. And if you're not watching the case in Arizona, you should be because they're going after a whole bunch of subject to people for doing things wrong. Don't know how that's all going to work out. But subject to, and the 2% interest rates are starting to sell through and work their way out. So subject to is not quite as hot as it was. But seller financing, I've heard, I want to learn seller financing. That's how I want to do my investing. I'm teaching seller financing. I've seen like four seminars on seller financing from internet gurus in the past week. Maybe it's just because I typed seller financing in my computer and now Google and Facebook showing that to me. But it seems to be the new hot thing. But while it may be hot, it is not due. They've been seller financing houses since there have been houses. So, why this deal? This house over here in Blue Springs. This was our flip that would not sell. Sounds like what a lot of other people are experiencing right now. We were lowering the price and lowering the price and lowering the price, and we didn't want to lower it anymore. How we made a profit to sell or finance this deal, how we found the buyer, what the buyer should look like, all that good stuff. How much we could have made if we would have held that note for full term the whole time, it said we had made a note for 20 years. If we would have collected payments for 20 years, how much would we have made? How we got our money back because flipping was our thing more than it was seller financing, and we wanted the money back so we could go flip another house or our private investor did, not our private investor, our partner did. We have a partner in this deal. Our partner came to us. He wanted to learn how to buy a house, fix a house, flip a house. He wanted to learn how to be a real estate investor. So he brought the cash to buy this house and his willingness to learn, and we brought the rehab money and we partnered on this deal and split it. I don't know our split ratio. I don't remember. We also, because he wanted his money back, we wanted our money back. We sold this note to a private investor. So there's certain things you need to do on a note so that you can sell it to a private investor. How he profited, how he could have profited if he would have still had the note, because it would still be paying right now today, and how seller financing can help good people that don't fit in bank boxes. So, for example, a bank has a minimum amount they will lend. So if you're borrowing less than what the bank will lend, they're not going to lend you money. Or you might be a contractor that might get paid cash from time to time and you might not be reporting all of your income. Should be, but that happens. And there's tons of small business owners out there like me, like you, that have a way of writing everything off. So while you make good money, in real life, when you put it all onto the tax return and take all of deductions you can, it might not show that you make enough money to buy a house. You have good credit, you have the money to make the payments, you just don't fit in the bank's box. Or might be like this guy, and we'll get into his story in a minute. So let's talk about this house. It was a Blue Springs flip house. You can see that picture there, raised ranch. I think it was 3 or 4 bedrooms. It had, kitchen, living room, dining room up, the bedrooms over the garage. Then it had a family room under, or next to the garage. So typical house. Um, our best educated guess was it was worth $179,000. I think my best educated guess was wrong. There were no comps in this subdivision in the last 6 months. I went against my better judgment and said, okay, well, this subdivision, one subdivision over, it has comps, same size houses, era, yada, yada, yada. 3 years ago, when we have comps, the two subdivisions were the same in value, so they should be the same in value now. So, based off of that, my best educated guess was the house was worth $179,000. Not wrong very often, but I was wrong there. We estimated repairs of around $25,000. So using the maximum allowable offer, the MAO formula, we used a 70% of ARV minus repairs is how much we can pay. We plugged all those numbers in, said we could pay $100,000 for the house. We did a little better than that. With the MAO of 100, we purchased it for 94. The rehab was a little more than 25, and then holding cost around 19. Holding cost and what else we have? Real estate taxes, extra rehab, some other fees that we had. But so all in, when we sold this house to our seller finance buyer, we had $138,000 into the deal. We listed it. We were at 179. Then we were at 175, 172, 187. I'm going the wrong way. I can't calculate anything. We started at 179. We went to 175, 172. We are finally down to 165. And I don't have this in a slide. I just looked this up. If we would have sold this house, just bear with me. If we would have sold this house at 160, we would have had to pay real estate commission, right? We would have had to pay our seller side closing costs, which would probably have been between 1,500 and 3 grand. At this time, we often had to pay the buyer's closing costs. So the buyer has closing costs, they can ask the seller to pay a certain amount of them. I would say around 5 grand. When I ran the numbers, if we would have sold this for $160,000 after we paid all these fees that we would have had, I thought we would have made around $147,000. And we had 138 into it, so we would have made what, 9,200 bucks? Not great, but it was better than poking an eye or losing money. So we were still willing to do it. But we had just been to quite a bit of training. Earlier in the year, or maybe the year before, Eddie Speed with Note School, he is the founder of Note School. He's been doing seller finance notes forever. He had been in Kansas City. Remember this? This was 2013, so we were coming right out of the Great Recession, and banks were sitting on buku boatloads of mortgages that needed to be foreclosed. The borrowers weren't paying. And instead of foreclosing all these houses and gutting them on the market, which is why we were seeing way fewer properties to buy, they were selling the notes to investors. And Eddie was coming to town to teach us how to go buy these notes from banks so that we could become the bank or get to the houses. We became a student of Eddie's and went to Note School, went through the mentoring. We also learned how to create a seller finance note. So we learned how to market for a good qualified borrower, to get substantial down, and look for a borrower with a good story. So we took what we learned. Well, we needed to learn a few more things too. We learned that if we were going to create a note that was sellable, and we were going to follow all the rules and regulations that came out of the Great Recession, we needed to hire a residential mortgage loan officer to do all of our underwriting paperwork because we were selling to an owner-occupant buyer. And while we only did a couple, and if you have to do more than three, we didn't know we were only going to do one that year. We didn't know what was going to go on, but we wanted to make sure we were doing everything right. So we needed to hire an RMLO. We didn't know how to do the paperwork anyway. And we needed to hire a servicer so they would collect the payments from the borrower, escrow the money for taxes and insurance, make sure they got paid. And then they would also do, send those little forms at the end of the year saying how much interest you paid and all the stuff that you need to do your taxes. That's what the servicer did. So we used what we learned and we went to our marketing and said we are open to the idea of a seller financed transaction for a good qualified borrower with substantial down. That says we'll take a look at what you offer, and if you come to us with what we like, especially that good story and a good substantial down, which is subjective, we would consider it. So we had some realtors that brought us some questions and are like, oh, we got $2,000 down, we got $3,000 down. Substantial down means a lot more than that. I would say we were looking for, 10,000, 20,000, but we didn't want to limit ourselves. If somebody came with 50,000, which, hey, we've seen that happen, we weren't going to turn them away. We wanted to hear their story. This is who we found. Not really this guy in the picture, that's clip art guy. But our guy had $20,000 down. So when he called and said that, he had substantial down. So we're willing to listen to his story. And was it a good one? He says, well, I am a contractor. I do roof repairs, replacements on behalf of insurance companies for insurance companies across the city. We're very busy. I'm pretty sure at that time we had a lot of new roofs going in. And my wife had been sick for quite a while, and she recently passed away. And during all of that time, I didn't work like I was supposed to. I didn't pay my bills like I was supposed to. My credit's trashed. We're like, okay, well, let's do a little bit of due diligence and see what we can do. So we used our resources from Note School and we did a credit report. It's kind of hard to just randomly go out and do a credit report as an average person and get a full-blown credit report. We learned how to do that at Note School. And his credit report showed just what he said. Everything was trashed. It looked like his wife, when she passed away, that he had received a life insurance and he had went and paid all of her debt. There was a lot of medical debt and he paid all of that off. He also had this brand new truck that he had purchased about a year ago, and he was showing good payments on that. Everything else was showing delinquent, not paid, foreclosed, what have you. So he was right. He had a bad credit report. We're like, okay, good story. Oh, wait a minute. There was more on that credit report. The credit report said he was deceased. He said, I can very easily turn around my credit report. I can go start making payments and get everything back in shape, but I don't know how long it's going to take me to prove to the credit bureau I'm not dead. So he was looking for a seller finance transaction, so he had a nice house to live in that he could repair and make updates to as he went along. Contractor, remember? Um, so I'm going to bet even on his tax returns, he probably wrote a lot off, so he wasn't showing a lot of income. So we're like, could we see bank statements? And he gave us these bank statements that showed he was bringing in way more money than he was spending. He made enough money to afford this house and then some. So we're like, okay, that works for us. Let's give it a shot. What do we got to lose? What's the worst could happen? We could have to spend 3 grand and get the house back in foreclosure. So we did the deal. We sold him the house at 165,000. He needed part of his $20,000 down for closing cost and to pay for the RLMO services. They're a little pricey. So he had 16,500 left to put down as a down payment. He got a loan at 148,500. He had an 8% interest rate. If he would have went to the bank, I would say he would probably have been at a 20-year loan, probably looking at about a 6% interest rate, somewhere around in there. He went for 240 months, was just 20 years, and his payment was $1,200 a month. That's what we put together. What would we have made if we would have held this for the whole 20 years? We would have made his down payment, and he would have made us almost $300,000 in monthly payments. If we subtract out our initial 138,000, we would have made in 20 years $176,000 roughly. But you also need to remember that on that 300 grand in payments, only the interest portion of those payments was income to us. The rest of it was our own money. So we didn't have to pay taxes on that. Plus, if this would have been a rental property, what would we had coming out of our pocket? We would have been paying real estate taxes. We didn't have those. That was on the buyer. Insurance costs, we didn't have that. That was on the buyer. Repairs, that wasn't on us. That was on the buyer. Which, by the way, as soon as he moved in, he did another $20,000, $30,000 in upgrades almost overnight to make the house the way he wanted it as a contractor. We didn't have to worry about keeping it rented, collecting rent, all of that. That was all on him. We just collected payments. And if we would have held it the whole 20 years, we would have made, we would have more than doubled our money. But our partner was not learning anything about flipping houses because all his money was tied up in this deal and he was learning about collecting payments. He was getting half of the payments or whatever our division was. So we learned at Note School that if we did all the right things, we made sure that the borrower had a good story and had substantial down and had a verifiable income, that the collateral was good, that we had a good house that was worth more than the loan, which we did. We'd rehabbed it. We knew it was a good house. We knew what it was worth. That we had done all the paperwork right. We hired an RLMO to do all the paperwork, so we knew that was right. We closed through a title company. We had mortgage insurance. We had did everything right so we could get the maximum amount of resale value out of that note if we went to sell it to somebody else. We started talking early on that we wanted to sell it to Grandpa, and I didn't say Grandpa. I'll tell you that in a minute. We had 219 payments remaining and we were owed $143,000. We found a private investor who bought it at a discount, $135,000. Our private investor was Grandpa. Grandpa had been lending us money for rehabs for quite a while, and he was good with a short 6-month loan, but he really didn't want a 30-year loan. But we're like, hey, this is a 20-year loan. Okay, but I don't know this person. He's a stranger. But after we showed him all of everything that was going on, how he was making his payments, how he had put extra money in the deal, everything, he decided he was interested in buying it. And he purchased it, like I said, for $135,000 at a discount. Now, what did we make on the deal selling Grandpa the note? We made our original 16.5. We made we earned the 21 payments he had already made at 26,000. Plus we made another 135, 400 and change when we sold the note to Grandpa. All in, after everything was said and done, we made $178,000. We spent $138,000 to earn that in 21 months for a $40,000 profit. Annualized rate of return was 15.3. Not bad when considering if we would have dropped the price to 160 and been able to find a buyer that would cash us out, we would have made $9,200. What the private investor could have made if he would have held that note to term, if he would have collected all 219 payments, he would have received $271,000 from a $135,000 investment, and he would have made $135,000. Kind of works out a little weird, but he doubled his money. And when you put that in how many months he owned it, he made he would have earned an annualized rate of return of 9.1 if he would have collected all 219 payments. But he didn't. Our borrower proved finally that he was no longer deceased, and or we're not sure, he did get remarried, and perhaps he bought a new house using the wife's credit. I'm not sure. But he bought a new house and sold this one, paid Grandpa off in 28 months. Grandpa collected actually 34,778 in payments. The payoff that he got at the end was 133,598. Total, he received 168,376. He had paid around 135, 136-ish if you remember. So his profit was $3,300 or an annualized rate of return of 11%. If you consider he was making less than 2% in a long-term CD, which was where that money was going to go and where it came from, we had to wait till that CD matured so he could get the money to buy it from us. And then after he got paid off, he's like, "Hey, you need some more money? Let's go find another one of these. Let's do some more." So I hope this case today kind of give you some ideas here. Being the bank pays off. We sold a house we could not sell. If we would have kept on and gotten lucky and sold it for 160,000, we would have made $9,200. Instead, we earned $40,000 in 2 years. That's what? 4 times as much money in 2 years? Not bad. We could have earned a lot more if we would have held it for the whole life of the loan. We were able to sell that note to somebody else and get most of our money back because we did we dotted all our I's and crossed all the T's and did everything right. Our private investor earned a little over 30, a little over. He earned almost $3,300 in 2 years. And that was way better than the 2% he was making in the bank. And let's look at that. Let's go back. He made an annualized rate of return at 11%. When he lent money to us as a hard money lender, not as a hard money, he was lending to us as a private investor, depended on the deal. Back then, I believe he was making 8% when he lent us money. That went down as money got cheaper. But that was still better than what he was getting lending to us. So, what do you think? Think you might need to have seller finance notes in your toolbox as an investor, perhaps as a realtor. It might help you sell a house that's not selling. It might help you find a different way to make money than being a landlord. Um, and you might earn a lot more money. So, think you might want to learn a little bit, and I think you should. I wanted to give you some opportunities to learn because I said we were talking about notes in January. At our monthly meeting on January 13th, note we are starting at 5:30 at the DoubleTree in Overland Park on the 13th. Jeff Watson, he is an attorney, he is a real estate investor, he is a note guy. He has been doing notes forever. Um, he is joining us on behalf of Note School because he teaches at Note School quite often as a student and as an educator there. He is joining us to talk about why investors are turning to seller finance mortgage notes. A lot of it's like my case study, but there's a lot more to it. There's a lot of ways to make money right now in mortgage notes, not just being the seller and seller financing, but being the private lender. You can also buy and sell these notes for profit. You can wholesale notes. Who knew that? Oh, I do because I went to note school. Um, then he's coming back on the 17th. We have a workshop from 9 to 2, and he's going to go through all the things you need to know before you do your first note deal to make sure you have a good note deal so it is sellable like it is in this case study. He also will tell you a little bit about what Note School has going on for long-term training. Like I said, I was a mentor student there, but they have boot camps and then they go on into mentoring, but they have a virtual boot camp coming up at the end of January. And then when they do meet in person, I would say that's probably February or March, it will be in the Dallas-Fort Worth area. And they do all of this a couple times a year. So if you wanted to learn more about that, come to the Murray meeting on the 13th. Check out our calendar. We'd love to have you come check it out and learn how to do a seller finance note so that you can put this in your toolbox. So in a couple years, when you're teaching the next generation of real estate investors, we'll be looking at your case study, not mine.